हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 19, दैट इज एम्प्लॉइज बेनिफिट पार्ट 5। प्रीवियस डिस्कशन वी हैड डिस्कस्ड अबाउट द शॉर्ट टर्म एम्प्लॉयमेंट बेनिफिट्स, देन वी हैड डिस्कस्ड अबाउट द पोस्ट एम्प्लॉयमेंट प्लान, देन we had discussed about the defined contribution plan, then we had discussed about the how to build an obligation. We had discussed various illustrations related to these topics. Today we are continuing with the illustration along with the solution. So let's start our topic. Illustration 1. Bharat Power Limited is a company with turnover of rupees 27,500 crores, having a large employee base. The company has provided a defined benefit plan to its employees. The following information pertains to the balance of the fund's assets and liabilities for the financial year 2019-20. Particulars: present value of defined benefit obligation, that is on 1st April 2019 it becomes 4,200 crores, and closing balance, that is on 31st March 2020 it becomes 4,740 crores. Fair value of plan asset, that is on 1st April 2019 it becomes 3,420 crores. 31st March 2020 it becomes 3,825 crores. For the financial year 1920, the service cost was rupees 165 crores. The company made a contribution of rupees 333 crores to the plan. No benefits were paid during the year. Consider a discount rate of 8% you are required to compute. Compute the balances of the companies to be included in his balance sheet and the amount to be recognized in the statement of profit and loss and other comprehensive income for the year 2019-20. Give the journal entries in respect of the amounts to be recognized. So in this case we have to prepare a plan asset account, that is a ledger account of plan asset account. Opening balance is given in the question. To balance brought down given, that is the fair value of plan asset 1st April 2019, that is 3,420 crores. Closing balance is also given in the question of the plan assets related to plan asset, that is by balance brought down. Means in this question all the closing balance is given. You have to prepare a ledger. By balance brought down given, already given 3,825 crores. Further contribution made by the entity in plan asset, the entity has made a further contribution, that is inflow to increase the plan assets in 1920, which become 333 crores. Any benefit is paid out of that plan asset is not given in the question, so it becomes 0. No benefit were paid during the year. Discount rate of 8% is also given, so interest is to be calculated on the plan asset. Opening balance interest is to be calculated. Opening balance given in the question is 3,420 crores, on which 8% interest is to be charged. So interest income 274 crores. In this case the loss comes out. The differential amount becomes either the actual gain or actual loss. Balancing figure becomes 202 crores, being actual loss on plan asset. Defined benefit obligation account, amount given in crores, that is the present value of defined benefit obligation as on 1st April 2019. 4,200 crores is given, that is on credit side, and in debit side the closing balance becomes the present value defined benefit obligation as on 31st March 2020 becomes 4,740 crores. This is also given in the question. Now by current service cost, as it is also given in the question, the current service cost becomes 165 crores. So by current service cost 165 crores. By interest cost, interest cost is there, unwinding of 4,200 into 8%, which becomes 336 crores. By actuarial balancing figure, that is 39 crores. In this way ledger is to be prepared. Items to be recognized in the financial statement for the year 1920. Opening net liability, opening present value of obligation minus opening fair value of plant asset. In this case obligation is more than the value of plant asset, so it becomes a net liability. So obligation becomes 4,200 crores. Opening fair value of plant asset becomes 3,420 crores. So net opening liability becomes 780 crores. Net interest expenses on net defined benefit obligation debited to PL. Net interest cost is more than the net interest income. As we had shown, cost on obligation is 333 236 crores, and interest income on plan asset becomes 274 crores. Differential amount becomes 62 crore. That becomes the net interest expenses. Now closing net liability becomes the closing present value of obligation minus the closing fair value of plan asset. The obligation becomes 4,740 crores. Value of plan asset becomes 3,825 crores, and the closing net liability becomes 915 crore. Now increase in liability, the closing net liability minus opening net liability, closing becomes 915 crores and opening becomes 780 crores. So it becomes 135 crores. So net remeasurement to be presented in OCI. Actual loss on plan asset 202 crores. So actual loss on obligation becomes 39 crores. 202 crores plus 39 crores, it becomes 241 crores. Now extract of balance sheet as at 31st March 2020 rupees in crores, that is closing net liability becomes 4,740 crores minus 3,825 crores. So it becomes 915 crores. Total entry how we will pass. So profit and loss account. Service cost become 165 crores and net interest becomes 62 crores. So total kitna रहा? PL account debit by 227 crores, 165 crores plus 62 crores. Other comprehensive income, actuarial loss on plan assets and actuarial loss on defined benefit obligation, that becomes 241 crores. To cash 333 crores. To net defined benefit liability, increase in liability 135 crores. Now another example is Ratna Limited pays a lump sum benefits on termination of service equals to 1% of the final salary for each year of service. The salary in year 1 is 1 crore, which is assumed to increase at 7% per year. The discount rate used is 10% per annum. So the build-up of obligation in respect of an employee who is expected to leave at the end of year 5. Ignore all actuarial assumptions other than the given discount rate. During the second year, based on the performance of the employees, Ratna Limited expect the last drawn salary of the employee to be 1 crore 50 lakh. What will be the impact of these changes? Discuss. So accounting as per the original assumption. पहले आप ultimate cost of benefit निकालोगे कैसे? Salary in year 1 becomes 1 crore. Salary assumed at the end of year 5 7% करके increment होगा. Salary assumed at the end of year 5 becomes 1 crore multiplied by 1.07 into 1.07 into 1.07 multiplied by 1.07. So it becomes 1 crore 31 lakhs 7,960. Cost of benefits on termination 1 crore 31 lakhs 7,960. 1% आप benefit दे रहे हो अपने employees को at the end of year 5. So last drawn salary at the end of year 5 becomes 1 crore 31 lakhs 7,960. उस पे 1% benefit मिल रहा है termination benefit for 5 years. So it becomes 6,55,398 is the total benefit paid on termination. Each year benefit is to be recognized at present value, attributing benefit to the period of service. As and when employee provide the service, the benefit is recognized. So this total benefit is divided by number of years served by the employee. So employee serve 5 years, after that he will get this benefit. Each year benefit becomes 6,55,398 divided by 5. So it becomes 1,31,080. This is the current year's benefit, means each year's benefit is provided. Should be recognized at present value. For recognizing present value, we have to prepare an amortization table. Opening obligation, that is 0 in year 1 because no obligation arises in year 1, so it becomes 0. Interest thereon 0. Discounting factor we will use at the rate 10%. In case we find out the current service cost at present value by multiplying with the reverse discounting factor. We will calculate current service cost, that is the present value of benefit attributed to the current year, that is 1,31,080 multiplied by reverse discounting factor. How it becomes reverse? Is 1,31,080 is paid after 5 years. What was the present value of that? So in the year 5 the discounting factor becomes 1. In year 4 it becomes 0.9091. This 0.9091 divided by 1.10, so it becomes 0.8264. In this way we will calculate a reverse way, and then we will find out the current service cost by multiplying this reverse discounting factor. In this case, in year 1 the current service cost becomes 1,31,080 multiplied by 0.6830, so it becomes 89,529. So opening plus interest plus current service cost becomes the closing obligation 89,529. These 89,529 becomes the opening obligation in year 2. Interest at the rate 10%. So it becomes on opening obligation interest is to be charged, that is 8,953. Current service cost becomes 98,482. So the closing obligation becomes 1,96,964. These 1,96,964 becomes the opening obligation in year 3. Interest at the rate 10%. So it becomes 19,696. Current service cost becomes 1,31,080 multiplied by 0.8264. So it becomes 1,08,330. That is the current service cost in year 3. The closing obligation in year 3 becomes, that is the opening obligation plus interest plus current service cost, that give rise to a closing obligation. So opening obligation in year 3 become 1,96,964. Interest is 19,696. Current service cost becomes 1,08,330. So closing obligation becomes 3,24,991. These 3,24,991 becomes the opening obligation in year 4. Interest is charged at the rate 10% on opening value, becomes 32,499. The current service cost is 1,91,163 and closing obligation in year 4 becomes 3,24,991 plus 32,499 plus current service cost becomes 1,91,163. So the closing obligation becomes 4,76,653. This closing obligation becomes opening obligation in year 5. Interest thereon is 47,005 and the current service cost in year 5 becomes 1,31,080. So the closing obligation becomes 6,55,398. In this way we will prepare an amortization table, and after that we will pass a journal entry, that is the illustrative accounting treatment. Employees benefit account debit, that is the current service cost. Year 1, as we had prepared in amortization table, that is in year 1 it becomes 89,529. That is at present value. Employees benefit accounts debit 89,529. Interest on year 1 becomes 0 because obligation is 0. So interest is also 0. So interest account debit 0 to provision for employees benefit, that is 89,529. Second year we will pass entry of current service cost, that is 98,028. Interest on year 2 becomes 8,953. So interest account debit 8,953 to provision for employees benefit 1,07,435. In this way we will pass every year entry. Sitting at year 2, the Ratna expects that the employee's salary at the end of year 5 becomes 1 crore 50 lakhs. So on that 1 crore 50 lakhs benefit is to be given on termination for the revised salary at the end of year 5. So it becomes salary in year 1 becomes 1 crore and revision happens at year 2. The management Ratna Limited has assumed that at the end of year 5 the salary increased from 1 crore to 1 crore 50 lakhs. Attributing benefit to the period of service, that is the revised benefit 7,50,000 divided by 5. So current year's benefit becomes 1,50,000. It should be recognized at fair value. So how we will recognize, how we will prepare an amortization table. In this way we will prepare an amortization table by cost becomes 1,50,000 for the current year's benefit into discounting factor on a reverse way. So opening obligation in year 1 becomes 0. Interest thereon at the rate 10% it becomes 0 and current service cost, that is the present value of benefit attributed to current year, becomes 1,50,000, which is to be multiplied with the reverse discounting factor, that is 0.6830. Present value of the current service cost in year 1 becomes 1,02,452. Opening plus interest plus current service cost, that give rise a closing obligation. It is the revised closing obligation in year 1 becomes 1,02,452. That closing obligation becomes the opening obligation in year 2, 2,452. Interest thereon at the rate 10%, which gives 10,245. The current service cost becomes in year 2 becomes 1,50,000 multiplied by 0.7513 becomes 1,12,697. That give rise a closing obligation 2,25,394. Revision happen in year 2. Increase in liability in year 2 becomes, as per the original term, the closing obligation in year 2 becomes 1,96,964. 4 revision, closing liability becomes 2,25,394. So increase in liability in year 2 is 28,430. That is 2,25,394 minus 1,96,964. These obligation is as per the revised terms, that is in year 3, 4 and 5. In this way we will calculate each year of benefit, each year of current service cost recognized at present value. So the journal entry become in year 1 as per the old terms, that is the original term. The accounting entry will be employees benefit expenses account debit, interest account debit, actuarial loss or past service cost becomes 0 in year 1 to provision for employees benefit, that is 89,529. Because change happen in year 2, conditions revised, employees benefit account debit by 98,482. This is as per the old term only. Interest is also as per old term only, 8,953. Only in year 2 the increase in liability as past service cost, the effect is to be given. It is 28,430 to provision for employees benefit 1,35,865. Thereafter in year 3, 4 and 5 is as per the revised term. The new amortization table which we had prepared, employees benefit is 1,23,967. Interest is 22,540. Actuarial loss or gain not arises because it is effect is already given in year 2. No effect is given in year 3. To provision for employees benefit is becomes 1,46,506. In this way we will pass a general entry in year 3, 4 and 5 as per the revised terms. Another illustration, Indrani Limited wants to motivate its sales personnel by way of an additional bonus. According to the Indrani's HR policy, the sales personnel would receive a bonus at 10th anniversary of their service amounting to 1x of their current monthly salary. In 1920, Indrani's management decided to increase this bonus to 3x of their current monthly salary. Indrani's make regular contribution to the fund for covering payment of these bonus. Based on the information in the table below, advise Indrani's how to present the employees benefit liability in the financial statement as of 31st March 2020. Particulars is in thousand. So present value of obligation as on 1st April 2019 is given. Closing obligation is given. Everything is given in this question. So based on the information in the table, advise Indrani how to present the employees benefit liability in the financial statement. We have just how to make the presentation in the financial statement with the help of this information. So we have to prepare a plan asset account, that is the ledger account, and defined benefit obligation account. Present value of obligation, that is opening obligation. So where it goes, defined benefit obligation account by balance brought down, because on credit side because obligation is always in credit side, 7,200 defined benefit obligation. Present value of closing is also given, that is 22,050 defined benefit obligation account to balance brought down. Present value of defined benefit obligation as on 31st March 2020, 22,050. Now interest cost, that is the expenses related to obligation by interest cost for 21-22, which increase obligation by 360. Current service cost becomes 1,935 by current service cost in defined benefit obligation with 1,935. Past service cost is also increasing the liability by past service cost 13,995. Benefit paid to the salesman becomes these benefit out of the plan asset, because आप plan asset से ही पे करोगे liability. Plan assets तो कम हो जाएगा, liability भी साथ में कम हो जाएगी. Liability कम करने के लिए आप डेबिट करोगे defined benefit obligation account debit to benefit paid out of the plan asset in order to pay off the liability, that is 1,350. plan assets में आप यहाँ credit कर दोगे because it is decreasing the investments by benefit paid out of the plan assets, so 1,350. Actuarial gain arises on obligation becomes 90. These actuarial gain is also given in the question, so it's tallied, that is opening plan assets is opening balance is always in debit side, so the fair value of plan asset as on 1st April 2021 becomes 6,750. Closing balance is 16,605. Closing balance by balance carried down, that is fair value of plan asset as on 31st March 2020 becomes 16,605. It is increasing the investment. So to interest on plan assets 338. Contribution to plan asset, further contribution 10,800. Flow to increase in the plan assets by 10,800 to employees contribution. Benefit paid out of the plan asset is 1,350. Differential becomes the surplus gain. In this case there is a gain of being actual return on plan asset by 67. It is also given in the question that return on plan asset less interest income becomes 67. So it is tallied. All the information is given in the question. We have to just present financials. So by preparing a ledger we have made a presentation. Now we have to prepare the items to be recognized in the financial statement for the year 1920. Opening net liability, that is opening present value of defined benefit obligation minus opening fair value of plan assets. In this case obligation is more than the value of plan assets, so it becomes the opening net liability by 450. 7,200 minus 6,750, so it becomes 450. Net interest expenses or net defined benefit obligation. What was the net interest expenses? In this case the interest income is 338 and interest cost becomes 360. Cost is more than the income, so it becomes net interest expenses 360 minus 338, so it becomes 22. Now closing net liability becomes closing present value of obligation minus fair value of plan assets. Obligation is more than the value of plan assets, so it becomes closing net liability 22,050 minus 16,605, 5,445. Increase in liability, that is closing net liability minus opening net liability 4,995. Remeasurement which goes to OCI becomes actuarial gain on plan assets plus actuarial gain on defined benefit obligation. In this case in obligation surplus is there and in plan assets also surplus is there, that is 67 plus 90, it becomes 157. Extract of balance sheet as on 31st, that is closing net liability become 5,445. Now how we will pass a journal entry? Service cost is current service cost plus past service cost 1,935 plus past service cost becomes 13,995. The current service cost and past service cost will goes to the profit and loss account. Interest expenses जाएगा जो कि आपने यहाँ पे net interest expenses, that is 22. OCI में जाएगा actuarial gain, that is 157. These are the expenses. OCI में आपका 157 is the gain. That is why I had put it in a bracket because gain on expenses, so differential amount आपका total comprehensive income में जाएगा. Plus minus करोगे तो 15,795. Journal entry profit and loss account, because service cost current plus past becomes 15,930 plus interest, net interest becomes 22. So profit and loss account debit by 15,952 to OCI other comprehensive income by 157 to cash, that is the further contribution 10,800 to net defined liability, that is 4,995. In this way you can pass entry और आप ऐसे भी कर सकते हो कि तो दोनों को नेट करके दिखाओगे तो 15,795 आपका आ जाएगा. You can pass both the way. Now extract of balance sheet as on 31st March 2020, that is the closing net liability becomes 5,445, which is the closing present value of obligation minus closing fair value of plan. Now another illustration. On 1st April 2021, the fair value of the asset of XYZ Limited defined benefit plan were valued at rupees 20,40,000 and the present value of defined obligation was rupees 21,25,000. On 31st March 2022, the plan received contribution from XYZ Limited amounting to rupees 4,25,000 and paid out benefit of rupees 2,55,000. The current service cost for the financial year ending on 31st March 2022 is 5,10,000. An interest rate of 5% is to be applied to the plan assets and obligation. The fair value of plan assets at 31st March 2022 was 23,80,000 and the present value of defined benefit obligation was 27,20,000. Provide a reconciliation from the opening balance to the closing balance for plan assets and defined benefit obligation. Also show how much amount should be recognized in the statement of profit and loss, other comprehensive income and the balance sheet. So we have to prepare a ledger account of plan asset, that is opening balance of that. It should be debited with the fair value of plan asset on 1st April 2021, that is given in the question, that is 20,40,000 and the closing value of plan assets is given, that is 23,80,000. The closing value by balance carried down given, that is the fair value of plan asset as on 31st March 2020, 23,80,000. Now the further contribution made by the entity plan asset account to employees contribution provided for the period, that is inflow to increase the plan asset 4,25,000. Now benefit paid out of the plan assets becomes flow out of the plan asset becomes 2,55,000. Interest on plan asset becomes at the rate 5%. Opening plan asset interest is to be charged at the rate 5%, so it becomes 1,02,000. Now the differential amount becomes the gain actual return on plan asset by 68,000 to surplus balancing figure 68,000. In the same way, we will prepare the defined benefit obligation account by balance given brought down because obligation is there on credit side. Opening obligation is 21,25,000. Closing obligation is 27,20,000. Debit side, that is 27,20,000. Current service cost is given, increases the liability. So by current service cost 5,10,000. Now interest cost is at the rate 5%. So on opening balance, interest is charged 21,25,000 multiplied by 5%. So it becomes 1,06,250 by interest cost. Benefit paid out of the plan asset in order to pay off the liability, so 2,55,000. The differential amount becomes the actuarial loss, that is 2,33,750. Items to be recognized in the financial statement. Opening net liability, because the obligation is more than the value of plan asset. In this case, the opening present value obligation becomes 21,25,000 minus the fair value of plan asset becomes 20,40,000, so it becomes 85,000. Net interest expenses, because interest cost which is more than the interest income on plan asset, that is interest cost is 1,06,250. Interest income becomes 1,02,000. So the net interest expenses becomes 4,250. Now the closing net liability, closing present value of obligation becomes 27,20,000 minus the closing fair value of plan asset is 23,80,000. In this case also the obligation is more than the value of plan asset, so it becomes the closing net liability by 3,40,000. Increase in liability, that is closing net liability minus opening net liability, 3,40,000 minus 85,000, so it gives rise to 2,55,000. Net remeasurements, plan asset gain arises, but in obligation loss arises. Plus minus, that is 68,000 is the gain, and actuarial loss is on defined benefit obligation is 2,33,750. Net loss becomes on obligation becomes 1,65,750, which is recognized in OCI. Now the extract of balance sheet as on 31st March 2022, that is the closing net liability becomes 3,40,000. Journal entry is to be passed. In profit and loss account, what amount is to be given? The service cost which is given in the question, that is current service cost becomes 5,10,000. Net interest 4,250. So 5,10,000 plus 4,250. So PL में ये दोनों जाएगा. Other comprehensive income 1,65,750. Actuarial loss on defined obligation, it is debited in other comprehensive income. To cash, that is the employee's contribution paid. Further contribution made by the entity on plan assets, that is 4,25,000. To net defined benefit liability, that becomes the increase in liability is here 2,55,000. So in this way the accounting entry is to be passed. Closing net liability which is presented in the balance sheet, closing present value of defined obligation minus fair value of plan asset, so it becomes 3,40,000. Thanking you for watching my video. Please like, share, subscribe my channel.